Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today has been quite an impressive day in the markets. At least volatility is here with us, and with volatility comes trading opportunities. But at the same time, you have to be aware of the risks that come in with volatility. So hello, Alvin. Thank you for joining the session. Always a pleasure having you in this session. So I'd like to begin with a mic test. So if you can hear me, kindly type hi on the live comment section. And of course, today I have a very quick quiz. What is the ticker symbol or the trading symbol for Salesforce stock? So if you know a company called Salesforce, what is the ticker symbol? Hi, Josephat. Hi, Vinod. Thank you for joining the session. So let's get this started. Today, it's going to be a little bit different to what we are used to. I have a couple of key lessons I wanted to deliver, especially to people who've just started their trading journey or intermediate traders who are currently struggling with profitability. So I've prepared this in form of a couple of tweets. So I'll be sharing my screen so that you can go through it and try to capture some of these moments. So let's get this started right away. So first one is a very common psychological bias that basically affects all of us. So if you are a trader out there, you know that it affects you. And once you see it, you will know it. So there's a very common saying, losses loom larger than gains. It was a quote that was done back in the 80s by a person called Kahneman. So it's a psychological bias commonly described as the loss aversion effect. So the pain of losing is psychologically about twice as powerful as the pressure of gaining. It is ingrained within ourselves through our evolutionary path. So if you're not so distant ancestor lost his day's hunt, let's say he was hunting a deer and he lost that one deer, it would be immensely painful compared to the pleasure he would get if he had an additional deer. So he has already caught his deer for the day. So if he got a second one, it would not be as pleasurable or within the same limits as if he had lost the same deer. So because on one side, losing his one and only deer would basically mean he's going to sleep hungry. So loss aversion in behavioral economics refers to a phenomenon where a real or potential loss is perceived by individuals as psychologically or emotionally more severe than an equivalent gain. For instance, the pain of losing $100 is often greater than the joy gained in finding the same amount. And this is a quote from Investopedia. So while this may seem like nothing burger, it is very real and it has an immense effect to your decision process as a trader or as an investor. So due to the fear of making a loss on your trading account, you may identify a really good setup with a high probability of winning and fail to take that setup because of this psychological bias. So I don't know if it has ever happened to you. You do your analysis, you identify a really good trade with a high probability of winning, but then you have a certain fear and you decide not to take it. So in most cases, if it happened to you, there's a good chance it was the loss aversion effect. So have you ever had a winning position, but you exited too early because you are afraid that the price could reverse? Or maybe you even adjusted your stop loss, put it too close to price, and then you exited with a small amount. And if you had been patient, the price could have moved as you expected, and you could have made more money. So if this has happened to you before, then you basically fell for the loss aversion effect. So another example, if you've ever held on to a losing position longer than you expected, hoping that the price would reverse. So in most cases, you enter your position normally, do your analysis, go for, let's say, a buy position in gold, and then set your stop loss. But then once the price starts going against you and it's headed towards your stop loss, that moment you start either adjusting your stop loss away from the price. Sometimes you just cancel the stop loss permanent trade, so you don't have a stop loss, and some other traders will enter a trade in the opposite direction. So if you had a buy trade, then you enter a sell trade just because you don't want to admit that you are wrong and you don't want to take that loss. So the loss keeps on getting bigger, and eventually your account gets wrecked. So if you've ever been in this kind of situation, then there's a high likelihood that that was a loss aversion effect at play. So if any of these scenarios have happened to you before, then here is quite a number of things you can do to make sure you don't fall back to the same kind of situation. There's also another example here. Have you ever entered an additional trade after losing streak to recover losses and end the day, week or month, and close the week at, or the period at a break even? For instance, let's say you've had a good Monday, but then Tuesday became worse, Wednesday became worse, Thursday became worse. And then on Friday, let's say there's a non-farm payrolls, and you decide to go for a big position, and you're hoping that as long as I recover the $300 that I lost over the week and I'm at break even, then I'm out of this market. And then once you go for that trade, it turns out that you are wrong in the market and you end up losing even more for that particular week. So if that has happened to you, I would like to see your comments on the comment section, and hopefully we'll get a solution around this. So hello, David. You can see Kenya, Kevin, and Innocent. Thank you guys for joining the session. I'm seeing some funny names, so if the name you present is not readable, I'll just skip through it. Freaky Slick, Ruben, Lemuel, and Joseph. Do you recommend CNBS or Finviz? I recommend Finviz. So if you've gone through the cases I've highlighted, I would like to hear your feedback on the comment section. So let's proceed. So how do you save yourself from this loss aversion effect? So the first thing that you need to do is to set a clear, predetermined entry and exit rules, and make sure you write them down. So before you enter the market, make sure that the rules for your market entry are written down, so you know exactly what you're looking for when you're analyzing the market. And when that happens, that's the only reason that you get into the market. And of course, when it comes to exit, make sure that there is a predetermined rules saying that if the market does this and this, then that tells me to get out of the market. So second thing, make sure that you fully understand the risks that you're taking and fully accept them. Make sure that you own the risk that you're taking in the market. Own the responsibility of every trading decision that you make, and feel the pain at the entry note after entry. So if your account balance is $1,000, you want to risk $20 in that trade, make sure that you have fully internalized that your new balance is 980. So once you go for that trade, you know that the worst that could happen is you losing $20. And in that case, you should be comfortable with having a balance of 980. So on the other hand, if the trade goes well for you, and let's say you're targeting $100, then you celebrate the win if, let's say, you make it to $1,100. So that, don't take a bigger risk than you can handle. We all know that this particular effect, loss aversion effect, takes more weight on you when you take a bigger risk that you can handle. So a trade risking, say, 1% of your capital would be easier to manage. It will not emotionally drain you. You'll not be waking up at the middle of the night to check on the markets. But if you decide to go for a bigger amount, say 30% in a trade, then in that case, you're taking too much risk, and this could cause you to fall for the loss aversion effect. So number 4, understand that the market could have behaved the same way, the same exact way, whether you had that position or not. So the market is not working against you, it just is. So I normally like to compare this with football. So if, let's say, there's a game between, let's say, Arsenal and Man United, whether you, let's say, bet on the game, whether you placed bet on that game on who wins or who doesn't win, it doesn't change the outcome of the game. So the game is not working against you. If Arsenal happens to lose, it's not like they're working against your bet there's absolutely no relationship between the event and what happens to your account. So in this case, remove all those affiliations with the market. Don't say the market is going for you or against you. Whether you participated or not doesn't matter. The market would still have behaved the same way. So the market is not against, it's not working against you, it just is. So if you're wrong about the market, exit early and preserve your remaining capital. So number 5, don't risk money that you cannot afford to lose. Don't trade money that you will need next month to pay for your rent, school fees, to buy more stock for your business, or even other bills. So make sure that the amount of money you are using to trade is not something that you need for your immediate needs. So the best way to think about this is to risk the amount of money that you wouldn't need to access within a year. So that way you'll have more room for safety and you'll be more focused. You won't fall for the loss aversion effect. So imagine you're trading in an account and you need that account to provide you the next meal. So if you happen to enter a trade and the market goes against you, you'll not be able to take a small loss. You'll just be holding onto the position, hoping that the price would eventually turn, and you end up with a winning trade that provides you your meal. So lastly, manage your expectations. Loss aversion is much stronger when you need that profit to pay your next meal. So make sure that you have a secondary source of income so you don't project your needs to the decisions you make in your trading account. So if you don't have a secondary source of income and you're fully depending on that account, then there's a high likelihood that you'll make projections to that account. I need to pay my rent by end month, and that money must come from this account. So you find yourself even justifying opportunities in the market, even if none exists. For instance, on Monday, the market was really slow. We didn't have any opportunities. So if you don't have those projections on the market, you'd be patient and wait until opportunities start coming up on Tuesday, Wednesday, Thursday, and so on. So I hope that makes sense for everyone. These ones have happened to me. Thank you for your response, Dennis. Hello, Kazadi, John, and Agostino. So the second lesson I'll be presenting today will be very important now that we have learned about the loss aversion effect. Let's learn about the novice trader and how they normally get wrecked, especially during news. So the novice trader that gets wrecked during news announcement faces a common miseducation bias and they don't realize it until they get wrecked. So in most technical analysis lessons, and this includes the lessons I've presented myself, you learn to set stop loss orders just below the previous low or above the previous high. So this can vary in naming, but it's essentially the same thing. So a confluence level, a support, resistance, accumulation zone, distribution zone, Fibonacci price level, and so on. So in most cases, when you go through technical analysis lessons, you realize that it's a very common concept. I'll give you an example. Let's say you are trading Euro USD. So in this case, let's say you are having a short selling trade right after the market tested this resistance. So I'll try and highlight here. So this was the previous high in the market here. You can all see this. So the market was going up yesterday, found resistance, pulled back, and then today formed a shooting star here. So if you decided to go for a short selling trade, so you enter a sell trade here, then in most cases, your stop loss would be just above the previous high. So in this case, you would probably set your stop loss here, entry here, and target way lower. So in this case, if you are wrong and price goes against you, you exit with a small loss. And if you're right, price goes for you, you exit with a good profit. And that remains quite a common theme for a majority of our Forex trading setups. So it doesn't matter which chart you're trading, it's a very common thing that you will find in the markets. So same case here, if you decided to go for a short selling trade, your stop loss would probably be right here. So if you, let's say, decided to sell here, your stop loss would be here, just on the previous high. So in that case, you have an invalidation point. So let me get to the point and show you how this affects you, especially if you're trying to trade news. So the stop loss order represents a price level where the initial idea is no longer viable. So if you're buying a stock and the stock is valued at $20, if you set your stop loss at, let's say, $16, you're seeing that your original idea or your original analysis is no longer viable. And that's your invalidation point. So the distance between the stop loss level and the market price is often relatively small, which allows the trader to take a small, manageable risk. So when the trader decides to trade a news announcement, there is often a huge spike in price, which creates a huge gap between the would-be stop loss level and the market price. I'll give you an example. If you look at the recent news that happened in Bitcoin, so we saw the price spiking higher after the announcement of a win for Grayscale, for Grayscale ETF. So when this happened, Bitcoin price jumped all the way up and kept going higher and higher and higher. So if you are a beginner trader and you are considering entering the market, let's say you found the news late after the market had made the big move, you probably went for a buy trade at the top. So if you look at the 1 hour chart, this is how it looks like. So if you, let's say, decided to go for a buy trade, let's say at the top here, or even during the 3rd hour all the way up here. So when you decide to go for your buy trade here, according to the technical analysis lessons that you've been learning, you've learned over time to set your stop loss just below the previous low. However, there's a problem here. If you decided to buy around this area or even around this area, most traders will think about the nearest low, and the nearest low is not that near because there's a big spike in the markets. So in this case, you find that there's a huge difference between your entry point and where you intend to set your stop loss. So if you don't understand this concept, you feel that it's very wrong to set your stop loss mid this candlestick. So if you're buying here, you don't want to set your stop loss across here or across this tall candlestick here. You want to set it at a support level. And clearly, you can see that there is a very strong support level on Bitcoin that was holding on quite well around this area. So your initial intention is to set your stop loss here. So when you do so, you can see the big difference between your entry point and your stop loss, which basically magnifies your risk. So if you normally set your stop loss at, let's say you're trading 0.01, you normally risk $10, then this could be a multiple of the same. Maybe instead of risking $10, now you're risking $50. So say you normally trade 0.1 and you normally risk, let's say, $50, then this could expand your risk profile to, let's say, 200, 300, and so on. And this can be a common thing that affects traders. And when it affects you, now you'll know what to do. So when this happens and there's a big spike and you decide to set your stop loss all the way down, what you're basically doing is taking a much bigger risk than you'd otherwise take in a normal trade. So in a normal day where we don't have big spikes in the market, you normally, let's say, risk 1%, 2% of your account. And now you've moved this higher. Maybe now you're risking 5 to 10% of your account. So this can be highly detrimental. And that's why you realize that a majority of the time, when you lose a bigger amount than you anticipated, you are more than likely to have traded in an environment where there was a news announcement and the difference between your entry point and your stop loss was much larger. So in some cases, it's a torturous mental game where some traders may even consider trading that without a stop loss because they deem the stop loss to be too far away from entry point, and they are right. Where they are wrong is not setting a stop loss. So the trader's brain is not used to setting stop loss mid candlestick, and to them it feels wrong. So it triggers fear whenever they think of setting a stop loss order mid a candlestick spike. So the trader follows default settings and sets their stop loss order to the nearest low or high. Well, this is consistent with their belief system. They do not realize the immense risk they are taking since the stop loss order is too far off their entry point. So a pro trader would realize this easily, and they would either forego the trade, they wouldn't make a market entry. They would also adjust the lot size significantly lower to maintain the risk profile. So a trader that normally trades 0.1, they would lower their risk profile to, let's say, 0.01 so that they can accommodate such a huge stop loss. On the other hand, they could adjust the stop loss higher and set it mid-spike. So while the beginner trader would not find it comfortable to set a stop loss mid-spike, a pro trader would be more than comfortable because they're more focused on risk management than being greedy in the markets. So when it happens and they are wrong, the Forex trader endures a long correctional movement that leaves their account in stitches. So look at the chart of Bitcoin. I think I've already shown you that. So for the trader that made an entry here, set a stop loss here, you can see the long enduring reversal that had happened over the last 2 days. And now the market is almost getting to their stop loss. So in this case, if you are a pro trader, you decided that this market is continuing higher, then you should have probably set your stop loss closer. So if you normally risk a couple of pips, maybe you should have set your stop loss around here. And if you're wrong, you exit with a very small loss. And if you're right and the market continued higher, then you make your money. So that's basically a key lesson that I felt it was necessary to present today. Hopefully, it will help you guys in making your trading decisions. So I'm still checking on the responses. So it happens until you always treat the market with suspicion. Thank you for the response, Kevin. What is the symbol for BTC USD? Hello, JSquad. We show up tonight. Thank you. So last lesson I'll be presenting today before we look at a couple of charts and news announcements will be how traders basically lose money during spikes. So beginner traders will almost always lose money when price spikes during news announcements. So a big green or red candlestick excites them and they throw away any risk management lessons that they have learned. I know it has happened to me before, so I know it has probably happened to you. You're just trading normally, and then there's a big spike happening on a chart that you're interested in. And when that big spike happens, sorry, just a moment. So when that big spike happens, you get excited. You start wondering how you could have benefited from that. You get this feeling of fear of missing out. You have this strong belief that the market will continue in that direction. And you get this excitement that you also need to participate in that market. So when that happens, you often make mistakes. And that's where I find most of the traders losing money. So at this point, it's greed, fear, thrill, and overshot expectations driving their decision-making process. So it's no longer the usual 1 to 3% risk they have been applying all month. I don't know if this has happened to you before. You are very professional, you have the rules written down. So every time you're making a market entry, there has to be a very good setup with a high probability of winning. You decide to risk 1%, target, let's say 3, 4, 5%. You let the market play out, you make some good casts. In some cases, you make wins. Some other cases, you make losses. You trade very well, build that account for, let's say, a month. Then towards the last week of the month, you find a very big spike in the markets. Let's say there's non-farm payrolls, FOMC, it doesn't matter what the news is. And there's a very big spike in the market, and you completely forget about your risk management rules. You just put them aside. You say, now we are riding this. This is where you're making the home run for the month. So when you decide to go for those positions, either you trade a bigger lot size or whether you make so many trades, you end up wiping up all the profits you had made earlier in the month. So if it has happened to you before, let me know in the comment section, and we'll see how we discuss this, and hopefully everyone gets to improve. So it is the realization that if they had captured the big spike, they would have made a huge gain. So in the spirit of FOMO, fear of missing out, they buy a top or sell a bottom. And in some other cases, it's because it has happened to you before. You saw a big spike some time back, you entered and you make some crazy amount of money. And now that has never left your brain. You still want to replicate the same. So if at any one time you traded news and the market gave you like something like 1,000 points within a couple of minutes, 2,000 points within a couple of minutes, and you exited with a profit that would have otherwise taken you a month to make, then you always want to replicate that. You have that inner hunger. You want to capture that move. So every time there's a news announcement, it gets you very excited. I wanted to use another word. And in that case, when it happens, you end up basically wiping up all the profits that you've been making earlier in the month. So to avoid getting wrecked during news, here's my advice. So number one, even if there's a huge news happening in the market, don't risk a higher amount than you would otherwise risk in a normal market condition. So if during a normal trading setup, you risk $10, then make sure that even during those news, the area you enter, the lot size, you are just risking $10 in a normal trade setup. So if you don't know what was announced in the news and you don't know how it affects the asset you are trading, then it's better to stay off that market. And three, if you missed a move, let's say there's a big spike in gold and you are not participating in the market, you have no business chasing after that move. Just let it go and wait for the next opportunity. The market will always present more opportunities. Lastly, trade what you planned. So if you see someone just highlighting something happening on social media, maybe it's even Rufas just saying, oh, this has spiked here. If you had not planned for it, just avoid it. So wait until you have something that you prepared. And in that case, you basically take control of your trading decisions. So that was the last lesson for the day. So I'll also be looking at your comments to see what you're saying. No major movement today. Just joined. Yes, it has occurred to me. Thank you. CPI, that one, NFP messed up. So the non-farm payrolls are coming up tomorrow. This is the most anticipated news for the week. So hopefully we'll get some good volatility and it will present some good trading entries as well as exits. So for today, we have had quite a number of data announcements. I believe the most crucial ones was China improving manufacturing PMI, which was quite bullish for oil. Non-manufacturing PMI, or basically the services sector, slowed down but still within expansion territory. We had European inflation coming in at 5.3%, which is equal as the previous month, so no drop in inflation. And core inflation dropped to 5.3% from the previous reading of 5.5%. So that was a mixed data point. Then core PCE price index increased as expected to 0.2%. And this basically shows that inflation is rising again in the US. So July's inflation data came in stronger than expected. And now core PCE price index also was stronger than expected on the year. But it was equal with the expectation on the month. Then unemployment claims are reduced to 228K. So when unemployment claims are basically reducing, it basically means that there is less people claiming for unemployment insurance because the labor market is strong. So this is the first confusing data showing a healthier US economy. The other data we have been seeing for the week have been showing a weaker economy, especially manufacturing PMI, which was below 50. Sorry, not manufacturing PMI. Preliminary GDP, which was below 2.4%. This was 2.1%, indicating a weakening US economy. Number of jobs created in the private sector, 177K, lower than the previous reading of 371K. So all these data points we have been seeing in the US have been indicating a weaker US economy. So number of job advertisements, 8.83 million, which was lower than the previous reading of 9.17 million. CB consumer confidence weakening. So all these were basically indicative of a weakening economy. So today was a little bit confusing, and we expect the final data point for the week to be the non-farm payrolls, which will be coming up tomorrow at 3:30 p.m. And of course, we expect at a number around 169K. So if there's a lower number of jobs created, it would mean a softening labor market. But then if there's a bigger number, it would mean a tighter labor market, which would be a big input in the Fed's decision that should be in the next month, in September. So also we'll be looking at the ISM manufacturing PMI, and of course the final official manufacturing PMI at 4:45 p.m. So knowing this, when we now look at the charts, we know what to look for. So one, the dollar index started the day strong and has been completely strong for the rest of the session. So with a very strong dollar, we have seen the pound breaking this flag towards the lower side. So this is something we had discussed earlier in the morning during the market snapshot series. So the USD kept losing to the Japanese yen, though there was some spike around midday. For the Euro USD, continued losing to the dollar. So now we are back to this particular trend line and could be the bouncing point. For USD CAD, this is what we have seen, a market that was literally moving sideways. There was some hints of volatility for the day, but still you can see the price is very close to the opening price. So that's a large required day, whereas gold has eventually broken to the lower side. So we were monitoring this sideways momentum. Eventually the price broke to the lower side and now is pushing further back downwards and almost getting to a nice target around this area here, which was acting as the resistance. So for AUD-USD, this is what we are seeing, market that is basically breaking back downwards. Basically, the Australian dollar weakening against the dollar. So we can see the sequence of lower highs on the 15 minutes chart indicating some form of consolidation, but at the same time, the pressure seems to be increasing further back downwards. So US equity indices had a move eventually. So after being relatively muted, moving sideways, we eventually saw a breakout to the upper side. The market pulled back, retested the area, and now is headed much higher. So there is a good chance we'll be seeing some further upside momentum in US equity indices. So that's the NASDAQ. If you look at the Dow, opened the day, broke towards the upper side and now pulled all the way back down and now is attempting to recover. So some good volatility came in from that. And of course, we had this setting triangle on the S&P 500, a breakout, market pullback, went up, pulled back, and now is headed back up, basically indicating there's a very strong momentum for the S&P 500. So there is a good chance we'll be seeing a continuation of prices higher. So this price action pattern on the 15 minutes chart is indicating a very strong entry by buyers. So expect some form of continuation on price. So as for oil, we had this breakout happening early in the day, a pullback and now a continuation. So now we expect oil prices to keep pushing higher. And of course, the target is the previous high here. So it's basically a 4-week high. So we expect a rally towards $87.68 per barrel. So the French 40 index eventually made the drop and now seems to be finding some level of support. But clearly from the forward chart, you can see it's the end of this swing. So potentially could be seeing the downswing continue. So European equity indices are basically moving back downwards with the UK 100 being the most volatile one, especially after breaking this pattern that we were monitoring in the morning. So attempted to break higher, failed, and then dropped all the way back downwards. So as for Bitcoin, it's basically a reversal of the entire move that we had here. This was on Tuesday. So you can see the sideways momentum on Wednesday. Today on Thursday, Bitcoin price reverses the initial momentum that we had here. So that's it for the day. Thank you very much, guys. Thank you for your time. And I hope to see you on the next session. So just checking the comment section. These ones mess up majority of new traders. What if you digest the news and after the news, look at the market does not go your way? There's always that risk. Sometimes even after you digest the news, the market may not always go your way. So that's why we always focus on capital preservation before growth. So in case you realize that you are wrong, then you take a small loss and then wait for the next market opportunity. Take us through imbalances and order blocks. I might consider doing that in another session. Today is our time is almost up. Oil moving nicely, yes. The bullish momentum is good. Speak about strategies like ICT breakout, Fibonacci retracement. I think I'll consider that on the next session, next Thursday. Which time frame is better to hold the trade? time frames are not the ones that you actually use to hold a trade. If you are holding a trade, you are holding that trade based on price, and the price is always the same on all time frames. So whether you're watching the chart from the 1 minute, 5 minutes, 15 minutes, 1 hour, 5 hours, daily, you're just holding the same asset and the price is the same across that. So time frames only apply differently when you're doing your analysis and projections in the markets. Pound yen also seems to be falling. Just bought UK was to increase rates, hence expected pound to keep going up. So there's a high likelihood that they may follow the US. So potentially a rate pause may happen this month. That's just my analysis, and that's why we are seeing some form of weakness happening across board. Gold should get to that previous support, caught the sells. Let me check. This is from Edwin Kamau. So the previous support is just around here. It's a 1938. So this is the like the immediate, because it's not like extremely that bearish. We are still in this channel, and gold seems to be extremely bullish. So after this couple of weeks, this was like 5 weeks sell-off in gold. We are getting our second week of bullish momentum in gold, and it's quite rewarding. So now that we are seeing this form of pullback, it would not be a surprise if we see the price bouncing from this level and continues with the bullish momentum. So that would not be a very big surprise. So overall, gold is bullish, but very short term, it's still bearish. So for a swing trader, how do you determine your take profit from 4-hour time frame or 1 day? So for a swing trader, you can identify the previous swings and use them as your targets. And at the same time, you might consider, and this is very important, the monthly versus weekly highs and lows. So if you are a swing trader trading on the 4 hours, last week's high and low might be a very good guide. This month's high and low, last month's high and low tend to be very useful when you're doing your analysis. So how do I get a broker? I work with FX Pesa, which is a financial market broker that is licensed and regulated by the Capital Markets Authority of Kenya. So if you'd like to trade with us, I'll be dropping a link in the comment section. So there is the link. So if you're a swing trader, let's say you're trading gold swings, then just zoom out and you can see the swings. These are swing up, these are swing down, and these are swing up on the 4-hour chart. So you can already see that the highest price we have seen in gold this year was here. Also this high price. And now you can see that the market eventually broke this trend line. So if you're concerned, the market broke here, pulled back, and now we are seeing this retest. So from a 1-hour time frame, you can see the break and the market pulling back to retest the trend line, potentially breaking higher. So from here, you can identify that swing. Now, if you look at the weekly price action, last week's high has already been broken. But then if you analyze how that last week's high was broken, you'd notice that this is last week, this is the highest price we got last week. So market goes up, faces that area, fails to break, faces, fails to break, eventually cruises through the entire place. So if you use the 1-hour time frame and then you zoom out, you notice that last week's price action was around here. So we tested the first time, second time, and then the third time cruised through that price level. So from then you can see that the price has continued to accelerate higher. So I hope that makes sense. So I think I've answered all the questions. Thank you very much, guys. See you on the next session. And of course, remember to check out the latest episode of the Bullish Banter podcast, available on YouTube. It's also available on Spotify, Google, and Apple Podcast. Tune in, basically all podcast platforms. So once you check out the podcast, make sure to share your responses. So in the latest episode, we had a very nice trader who basically focuses on options, a Kenyan who basically accelerated their trading journey right from Nairobi all the way to the US.